In this video, I'm going to reveal to you 6 stock market signs that are screaming bull market, so that you'll be able to take advantage of this potentially huge wealth creation event. Hey there, this is the Estate Financial Channel, where we break down financial concepts in under 10 minutes. I'm going to show you 6 market signals that are telling you we have just entered a bull market. After a 20% plus drawdown in stocks last year, 2023 had many people worried about a recession. While those fears are still around, the first quarter of 2023 stocks have been booming, and some important signals are telling us this trend is here to stay. These 6 reasons we've entered a new bull market are too big to be ignored. Sign number 1 we've hit a bull market is the weakening US dollar strength. Thinking of it in terms of simple supply and demand. As the value of the dollar goes up, it buys more stock, and so the value of stocks, relative to a dollar, goes down. And that's exactly what we're seeing. This chart shows the S&P 500 index in the orange line and the US dollar index, or DXY, in the other line. As the US dollar strengthened, the stock market bottomed out in October. What's encouraging is that since October, the US dollar has weakened, despite interest rate and bond rates increasing. You can clearly see the downtrend in the US dollar and how it can inversely track the stock market. Here is a monthly look at the US dollar index. In purple, the S&P 500, in orange, the Nasdaq 100, in green, and Bitcoin, in blue. You can see the same inverse correlation here. When the US dollar goes up in value, risk assets go down. Now back to the current USD index. You can see it has been trending down since October, despite rising interest rates. If you think this trend will continue, then the stock market should go up. Not so coincidentally, the bottom of the stock market was in October 2022. That lines up within 2 weeks of the strongest the USD has been in decades. Should these trends continue, equities will go up. Sign number 2 is seasonality. We'll be looking at 3 annual trends and what they say for 2023. First, back-to-back down years are rare for the stock market. Since 1928, the S&P 500 index has only fallen for 2 years in a row 4 times. During the Great Depression, World War II, the 1970s oil crisis, and the start of this century's dot-com bubble. Since 1957, the S&P 500 has ended the year in the red 18 times, including 2022. On 14 occasions, the index returned to growth the next year. And while history might point to an upbeat 2023, on average the S&P 500 gained 16.8% in years following a negative year. There are also some cyclical political trends pointing towards a stronger than expected 2023 as well. 2022 was a midterm year, which has historically been a bad performing year for equities. But you could see the year following a negative midterm year is very positive. It's averaged a 25.4% return since 1960. Likewise, the presidential cycle is pointing to a solid year too. The third year of a presidential term has the highest returns, averaging 16.8% average. This has consistently been the best year of a presidential term for stock market returns. Sign number 3 is market behavior, or specifically price action. I encourage you to observe this for yourself, but the market behavior has changed this year. Some new developments have been that on the market's worst days, there are still 1 to 3 sectors that are positive. This is a much better sign than when everything is negative and money is only flowing out of the stock market. Even on bad news days, stocks have been recovering and even climbing. This type of behavior we haven't seen since 2020 and is very bullish behavior. It indicates we have firmly moved from sell the rip to buy the dip. Sign number 4 is supply. Without new stocks flooding the market, existing stocks see a boost of momentum. 2020 and 2021 saw an explosion of SPACs and IPOs, but that market has since dried up. 2023 so far has seen less than 5 new SPACs, which is 81% less than the previous year. The IPO market is almost as bad, with just 30 IPOs this year, marking a 66% drop from last year. Without this new influx of stocks, more money will flow to the established companies. Sign number 5 are fundamentals. Many are looking at the extreme inflation last October and December and saying the end is closer than the beginning. If inflation does continue cooling, the Federal Reserve will almost certainly reduce interest rates. This would cause a huge rally in the equity markets and cryptocurrency market, as risk assets will rise rapidly. Finally, the stock market bottoms before we hit the deepest parts of a recession. The S&P 500 surprisingly rose an average of 1% during all recession periods since 1945. That's because markets usually top out before the start of recessions and bottom out before their conclusion. In other words, the worst is over for stocks before it's over for the rest of the economy. In almost every case, the S&P 500 has bottomed out roughly 4 months before the end of a recession. The index typically hits a high 7 months before the start of a recession. Since it is not 100% clear we are even going to hit a recession, the probability the stock market's October lows were the lows get better and better each day. Sign number 6 is technicals, or chart analysis. One of the most popular technical indicators is the 200 daily moving average, which we'll be focusing on today. The 200 DMA, which covers roughly 40 weeks of trading, is commonly used in stock trading to determine the general market trend. As long as a stock price remains above the 200-day DMA on the daily time frame, the stock is generally considered to be in an overall uptrend. At one point in February, over 74% of SP 500 stocks were above their 200 daily moving averages. Let's take a look at the 3 major stock indexes. The first is the Dow Jones Industrial Average. You can see it recently bounced off its 200 daily moving average, along its late December low, confirming using it as a support level. This is a positive sign, as it keeps the sideways trading range intact. Let's now look at the SP 500 and you can see the same thing. The 200 daily moving average was successfully defended, causing a reversal up in the price, and now that line is being used as a support level. Lastly, let's look at the tech-heavy QQQ, and you can see the same exact behavior. These all put these index into a technical bull market. As exciting as that is, I'd like to reward you with a little bonus for making it to the end of this video. If we are in a bull market, then what should you be invested in? The strategy of sector rotation gives us pretty good clues into what industries historically outperform at the beginning of a bull market. Sector rotation seeks to identify the economic cycle and make outsized returns by overweighting portfolios based on which industries are likely to perform well. This chart shows you the strategy and says you should be investing in. This is interesting because technology has been on an absolute tear to begin 2023. They've also become a bit of a safe haven as the top technology companies are very well capitalized. Under this strategy, you should be finding deals in technology, financial, cyclicals, and once production begins ramping up, begin buying industrials and basic materials. And there you have it. 6 very bullish market signals pointing to a continued great year in 2023. US dollar index, historical seasonality, market behavior, drying up of SPACs and IPOs, inflation, and finally the 3 major index above 200 daily moving averages. I hope you enjoyed this video. I always attempt to simplify complex financial situations in a way that most people can understand and benefit from. Smash the like button to support this channel and get more videos. In this video, I'm going to review